Okay, let's have a look at what the interest rate situation is doing to property prices around the country. I'll bring in Cameron Kusher, who's the Director of Economic Research from PropTrack. Thanks for joining us, Cameron.
Thanks for having me, Chris.
Let's first have a look at the numbers from last year so we can see the trends that have emerged. We see that in Sydney and Melbourne, property prices went back substantially last year, but in the other capitals, they tended to go forward regardless. And if we look to your forecast for this year, we're going to see that all of the capitals are going to have property prices going backwards and big falls in the major cities.
That's right. That's what we're forecasting. And really, this is because interest rates have increased so rapidly over the last year. And we are expecting further interest rate increases this year. We already saw one today, and we're at least probably going to get one next month as well. And basically, as a result of those interest rate increases, the amount that a bank will lend you has reduced significantly. It's down already about 25 to 30%. So quite simply, people can't continue to pay the prices for properties that they were when the cash rate was sitting at 0.1% throughout the pandemic.
So you're talking about average prices in the capitals going down by $100,000 or more?
Yeah, certainly in places like Sydney or Melbourne. And the reason why we're expecting larger price falls in places like Sydney, Melbourne, Hobart, Canberra and Brisbane is the differential between the cost of renting and the cost of servicing a mortgage in those cities is much wider. But also most of those cities have seen relatively stronger price growth either through the pandemic, Melbourne being the exception there, or over recent years. So it's a case of what goes up while interest rates are coming down reverses when interest rates go up, and that's what we're expecting to see this year. I think the important point to make, though, is in all cities, even if these price falls were to come to fruition, prices would still be higher than they were at the start of the pandemic.
Well, that's it. If you own a home, you've got to think about the long game. Your value might go down for a while, but if you're not selling in the near future, it doesn't matter. On the other side of the equation, though, people will be looking at home affordability and thinking that their purchase is getting closer, but of course that it's harder to buy when interest rates are higher.
That's exactly right. And if we look at what's happening with lending, we're seeing an ongoing low number of first home buyers entering the market. And, you might think that lower prices make it easier, but when borrowing capacities are down 30% and prices have only fallen around 4.5% nationally from their peak, it's not making it yet any easier for first home buyers to get into the market. And as I mentioned, in most instances around the country, it's significantly cheaper to be paying rent than it is to be servicing a mortgage. And that's likely to remain the case given where interest rates are.
Just very quickly, Cameron, how close are we to seeing a lot of mortgage stress and forced sales?
I think we've seen very low levels of mortgage stress and forced sales at the moment, but I think it's reasonable to expect that it's going to increase this year. If you remember, during the pandemic, people had a serviceability buffer in their mortgage of 2.5%. It was lifted to 3%. That's already wiped out. So if you were borrowing at or close to your maximum borrowing capacity, you don't have a lot of excess cash available to go and spend. So I think it is reasonable that we will see an increase in the number of people that are in a position where they have to sell this year, particularly as a lot of people on fixed rate mortgages get to that point of which that mortgage expires. And, they were expecting the interest rates to still be around 2%, and they're closer to 6% upon expiry.
Yeah, difficult times ahead. Thanks so much for joining us, Cameron.